So the next part we have got fixed exchange rate system. Okay, so what is fixed exchange rate? Well, it is an exchange rate set by the government and maintained by the central bank. So here in this case, that currency will be pegged with, or the local currency will be pegged with the foreign currency. Most likely it happens in terms of bilateral countries. Okay. Now a country would set the value of the local currency against the other in a fixed manner. So here in this case also it is a pegged exchange rate system, but this time it is following the central value. Okay, that means the rate would not be within the range, rather would be stipulated range. Sorry, stipulated rate, not range. Okay, so if it is about range, then it is managed float. If it is about absolutely fixed price, then it is a fixed exchange rate system. Okay, now such exchange rate systems are being practiced and were being practiced at past. Now, namely, I have got two countries, UK and UAE. Now, in case of UK, in between 1950 to 1967 or in and around 1970, they used to use this exchange rate system. There, UK had fixed the value of pound, okay, against dollar. So 1 pound was equal to $2.8. Now you can see 1950 to 1967. So a long duration they have practiced this fixed exchange rate system. Okay. Now after 1970, they have stopped using these. Rather, they have put their currency into the floating exchange rate system. But what we have, one country, UAE, is still practicing fixed exchange rate system. Okay. Now in case of UAE, 1 dirham is equal to $0.27. Okay. So what we see that UAE has been practicing this rate. Now the point is, this fixed rate is revised by the countries after a decade or maybe after a few years. Now this rate was previously 0.25, now it is 0.27. That means probably UAE has revalued its currency. Okay. Now one example that we can see that really UAE is practicing or not, you can see the graph 2016 to 2020. So within these 5 years, we see the exchange rate is 0.27. It did not change. Okay. Now that gives us a perfect example of fixed exchange rate system being practiced. Okay. Now see this fixed exchange rate at this point of time, we are talking about against the dollar currency. But in UK, basically, they also practiced fixed exchange rate system against gold within the European countries. So that was most likely would be called gold standard. As it is not there in your book or curriculum, so I'm not discussing those points, rather maintaining the balance between your books. Okay, so other than that, if it is about currency, then also it is to be called or it is considered as currency board. Okay. Now, other than currency board, there is another type of fixed exchange rate system that we can see is being practiced in currency blocks. That happens within the European Union. Anyways, so these are the types of fixed exchange rate system that we can see. Okay, probably gold standard is not being used, but the currency board and the currency block is very much being used at this point of time. Okay, so what happens in fixed exchange rate system that we see, or let us explain through this graph. So this is the rate a government would decide. Okay, that means the exchange rate should not be changed. Now sometime it happens because of import and export or demand for currency within the country or outside the country may impact the exchange rate here, that fixed exchange rate. So somewhere we see if supply of pound increases in USA. So we are talking about fixed exchange rate system in USA. Okay, so it is in USA, and what is being transacted is pound. Okay, now supply of pound in USA increased, causing the value of pound to go down. Okay, now I have used a little bit different graph. Probably you may use different graph to explain this. You may use dollars to explain that. Okay, so anyways, the pound supply increased in USA, causing value of pound to go down. So it should be within this line, but now it is here. That tells us what? That tells that probably dollar must have been appreciated. Okay, if value of pound is going down, that means dollar is being appreciated. Now it is USA, so USA would be considered about value of dollars. Now government has decided value of dollar should be within this line. Okay, but it is now here. So what to do? Now the value of dollar should go down, or in other way we can say value of pound should go up and then be maintained within this line. So in order to do that, government would do what? Let's say if it is about supply of pound increased, then government will increase the demand for pound. That means buy pound. Okay, so US government may buy pound in order to increase the demand, and probably it would come here. Now again I would say this demand would straight away would not come to here. Rather it will be step by step. Demand will increase as government would start buying pound in USA. And then when the rate comes here, government will say, well, we have achieved our targeted rate, so now we don't need to buy any more pound. Okay, so this is how the fixed exchange rate would be maintained. Now what we see, the value of dollar went down, okay, inverse way. Okay, as a result we will say here we have devaluation of dollars by the government or the central bank. Okay, so dollar was appreciating here. Now when it goes there, dollar will depreciate with the effort by the government. Okay, so this is also similar like devaluation of dollars or devaluation of currency. Okay, now let us see, or let us discuss what are the measures our government can take to maintain the fixed exchange rates. Now some of the measures like interest rate. We have been discussing interest rate quite a while, so I would not focus into this part. Okay, but we know that if interest rate is increased, somewhat outflow will happen in the country. Okay, and as a result demand for that currency will increase. Okay, now if that currency was depreciating, then there will have appreciation. Opposite way, if the country was appreciating, interest rate will be decreased, and then that currency will start depreciating. So whenever there is appreciation, at that time interest rate will be used in a way that interest rate will be decreased, and then the currency will start depreciating. Okay, so interest rate will be used or could be used as a tool to maintain the fixed exchange rate. Okay. The other way is to use that government may use, that is, government may buy or sell currency. Okay. Buying or selling the local currency, or maybe buying or selling the foreign currency. Both could happen. So if that country is experiencing appreciation in the local currency, that means that country would consider depreciation. Now, how to depreciate the currency? Simply just supply the local currency. Okay, that means sell that local currency. So supply will increase. As a result, that currency will be depreciating and it may reach to the targeted level. Opposite happen if that currency is being depreciated. Okay, then the government will buy that currency. If they buy that currency, demand will increase for that currency and then it will reach to the targeted level again. Okay, so devaluation and revaluation will be used. Okay, in a way that the government would either buy or sell currency. Then we have restrict capital inflow. Now see, if the government has kept the value at the central level and it is being maintained, all at a sudden what happens? Now some foreign investors think of coming to that country and invest. Now if foreign investors think of investing into that country, then they will demand the local currency. And as a result, local currency is likely to be appreciating. Okay, which is what the government would not like that to happen. So in order to stop that, what government is going to do? Well, government is going to say those foreign investors that you are not allowed to invest in our country. Okay, now how does that going to happen? Does that government going to say it directly? Well, the government would not say it directly. Rather, they may come up with some resolutions, laws that will say, well, foreigners are allowed to invest into that country, but only up to 1%. So if you want to invest into that country, you need to find a local partner who would invest 99%, and you as a foreign investor will only invest 1%. Okay, so by doing that, or by taking that measure, the government would actually contain the foreign investors to invest 100%. That means that investor would not be allowed to bring all 100% amount of foreign currency and then demand for the local currency. Okay, if in case of 100% investment, the demand for the local currency will increase in a drastic manner. Now that will be controlled by bringing out some regulation and then control the foreign investors investing into that country. So this is like restricting capital inflow to that country so that that currency would not appreciate, so that the rate that government would like to have is maintained. Okay, now next option is about number 4, that is exchange control. Now what happens in case of exchange control? A country would like to restrict their people to buy the foreign currencies. Okay, what happens if the people into that country demand foreign currency, then the foreign currency will be stronger and the local currency will be weaker. In a way, the local currency will depreciate. Now, probably that government would not like that to happen. And why is that? Because government has already fixed the exchange rate and they don't want that exchange rate either to go up or to go lower. So in that case, government of that country would restrict people, local people, to buy foreign currency. Now, how could they restrict? Well, they can restrict by telling people, if you would like to buy dollars, then you can buy up to some certain limit. Okay, which means probably one day $50 or $100, or maybe in a month $500, and not more than that. Now this way government would control the demand for the foreign currency. Okay, I hope this would be more than enough. Now, one thing to mention here, restricting capital inflow may also come under exchange control, but I just wanted to give you two different aspects, so I discussed this in two different aspects. Okay, two different ways. So restricting capital inflow may also come under exchange control. Okay, so domestic people, if they don't demand for the foreign currency, then they are not going to, that exchange rate is not going to be influenced. Okay, the other way, most of the time government try to come up with, like not telling people to not to buy the foreign currency. Rather they would say, well, or they will put some obligation and then try to know why do people would like to buy foreign currencies. Okay, now most likely in some cases people would like to buy dollars just to buy foreign goods and services. Okay, that means they want to consume more. Now government in that case would like to know from those people who would like to buy dollars or buy foreign currencies about their income detail. Okay, if government asks them about their income detail in order to buy the dollars or the foreign currencies, people will be scared to provide any information about their income. Now, if people are willing to buy dollars, not considering any government restriction, then in the future probably government will come up with some taxation, and that will allow them to put more taxes on their income. So as a result, people may be scared to disclose their disposable income. So this could also be one of the ways through which government would control the people to buy the domestic, not domestic currency, buy the foreign currency. Okay, I guess I have tried my best to explain it. If you think that any of my explanation did confuse you, then please let me know.